Hey everyone, welcome back to SumZero. Today we're talking with Christopher Godfrey from Headwaters Capital, which he founded, and we're going to be discussing small caps and mid caps and why they're sort of offering a unique value proposition today, especially what's sort of happened in the markets over the last couple of years. And I think at a very high level, it's worth noting that though markets have done well so far in 2023, a lot of that return has been due to, the mega caps, specifically some of the FANG names, NVIDIA, Meta, Apple, et cetera. And, at SumZero, we always try to kind of highlight opportunities that aren't necessarily being talked about in mainstream media and maybe just not getting enough attention. So with that, Chris, welcome to SumZero, and thanks for taking the time to chat with us. Just really quickly, when did you found Headwaters Capital, and maybe just give us a brief summary of your own investing philosophy and framework just to start.
Perfect. Yeah, Divya, thanks for hosting me. Excited to have this conversation. And like you said, discuss some names that are not NVIDIA, Apple, or any of the FANGs. This might surprise some people. There's actually some other opportunities out there in the market. But yeah, so to answer your question, so I founded Headwaters Capital in 2021. I spent 7 years at a long-only mutual fund. And basically, I thought there was a better way to approach active management in the public markets. And so my belief really is that, one of the biggest sources of alpha in the market today is really, having a longer investing time horizon. So Headwaters Capital it's a concentrated portfolio currently of 21 names. I'm focused on finding high quality businesses that have got some sort of a competitive advantage. They've got long runways for growth and high returns on invested capital. And the competitive advantage piece really allows them to capture those growth opportunities. So what I tell people is, look, if I can't look at a business and kind of have a good idea of what it looks like in at least, 5+ years, it's really not worth my time. So that's kind of the quick story on Headwaters. And I should mention too, it's focused on the mid-cap space. So
So let's talk about that space. I mean, first of all, why do you think it's underperformed, on a relative basis, the broader market so much, particularly over the last 2 years?
Yeah. And maybe before we get into everything, I've got to read some legal language real quick. So just so everybody knows, investing involves risks and uncertainties. Nothing discussed in this interview represents investment advice. And I advise all listeners to do their own due diligence on anything discussed in this interview. So that out of the way, we can get into the good stuff. So kind of like you said, Divya, right? So to answer your question on kind of why small caps have underperformed over the last 2 years, I think it's helpful to kind of reset everybody. So large caps actually up 5% over the last 2 years. Mid caps are down 8% and small caps down 18%. And if you bifurcate that even more, right? Growth has significantly underperformed value. So small cap growth is actually down 23% over the last 2 years. So, concerns, that the market hasn't corrected might be true in the large cap space. I do not think that is true in the small cap space. And so to answer your question on why that has occurred, it's been a combination of two things, right? So I've got a chart here on the left from Bank of America, and it's just showing where small cap multiples are today. So if you kind of say, hey, 2 years ago, middle of 2021, small caps were probably trading, at the high end of their range, call it, 20 times forward earnings. Today, they're sitting at 12 times. So that's significantly below the long-term average of, call it, 16 times. So part of the reason for the underperformance has been multiple compression. And that's driven by higher interest rates, concerns about recession. But the concerns about recession have actually already been reflected in small cap earnings estimates. So some data compiled by AllianceBernstein actually shows that 2023 estimates for small caps show earnings down 16%. And actually, if you look out to 2024, it kind of shows that they're going to be flat next year. So we're arguably nearing a trough in terms of the earnings for small caps. So the reason it's underperformed, multiple compression combined with negative earnings revisions. And that's why I think it's setting up to be a pretty attractive opportunity today.
How do you know that earnings are at a trough, though? Is that just a gut that you have, or is there's some more data behind that?
Yeah, so I mean, it's a great question, right? I don't think anybody ever knows the answer to that. And to be clear, I'm never trying to call, troughs or peaks for the market as a whole. But right, I would argue, right, you've kind of had rolling recessions going through the economy already, right? So, I mean, look at semis, right? They had a significant correction, trucking, parts of retail, right? Like you've just already seen, negative earnings or negative year-over-year growth for a lot of different industries. So, we may not be at a trough, but I think the point more is we're closer to a bottom than we are a top. And at the same time, multiples have compressed. So, I just think you have a couple of factors that are setting up well for future returns for small caps.
So, and then touching on central banking factors here, like obviously, like I'm not going to predict where rates are going, but it does seem like the consensus is that, the Fed might hike a little bit more, but they're, if anything, closer to, flattening out or potentially reversing than they are raising rates the way they did in 2021 or 2022. So what's your take on how, just interest rates may impact small caps? And are they, you would think they're more sensitive to interest rate moves than some large caps, but I'm curious what your take is.
Yeah. So, I mean, I think it's interesting, right? And let me back up a couple slides for anybody watching this, right? Small caps typically, lead the market lower going into a recession, right? They're going to underperform large caps. So I think this is, classic cyclical behavior here with small caps over the last couple of years. But the flip side of that, right, is that they are going to lead in the recovery. And so to your point on kind of central banks, we're pretty close to the end of the hiking cycle, in my view, right? I mean, one or two more hikes this year, and then we're probably going to at least pause. And if you kind of think about the dynamics, behind that, right? Small caps outperform coming out of or when hiking stops, right? And that's because, right, when the central bank stops hiking, right, the idea is we are either in a recession or very near a recession, right? And so when we're coming out of that, that's when small caps start to lead, right? The market's forward looking. And so I think that's kind of a signal for everybody that you can get into more of the cyclical names in small caps more broadly. They're just generally more economically sensitive, right, than large caps. And I think that classic cyclical behavior is about to play out whenever central banks stop hiking.
Let's go through a couple examples. I know there are a couple names that you've done a lot of work on. So yeah, can you give us an example of something in your portfolio that you're excited about today that fits in the small cap sort of market cap range?
Yeah, so right, I'm seeing a lot of opportunities in small cap today, right? And it's this valuation support for a lot of names and just kind of general apathy towards the asset class. I think one of the names I'm most excited about right now is a company called TransMedics. So the ticker is TMDX. So this company is revolutionizing the organ transplant industry. So they've got an FDA approved device called the Organ Care System. So for anyone watching, you can see a picture here. So what happens is between when an organ is procured from a donor and then transplanted in the recipient, you've got to get it, between point A and B. And so you actually connect the organs to this device. And so you can kind of see the consumable part of the machine here. You can put a lung or a heart or a liver on the machine and it pumps warm oxygenated blood through the organ during transport. And so the idea here is you're basically replicating the physiologic conditions of the body. And so what that means is, the heart or the liver or the lung arrives in much better condition. You get better post-transplant outcomes. And it also enables, greater utilization of donor organs, which I can go into. But maybe before we do that, it might be helpful to kind of reset everybody on kind of how the organ transplant process works. And then I think you'll understand the company better. So I can dive into that real quick if that's okay with you.
Let's do it.
Yeah. So I personally was not familiar with how organ transplants work. So, think about this, I'm in Atlanta. Let's say I need a heart transplant. I match with somebody in Nashville. So what happens is the transplant team leaves from Atlanta. They fly up to Nashville and they actually procure the heart. And then this was the shocking part to me. They just put it on ice in an igloo cooler and then they bring it back to Atlanta. And the idea is, right, if you store it on ice, you kind of slow the decay of the organ, which is true. But the reality is you only have 4 hours between when you can procure the organ and then actually transplant it into a body. And so the problem is like, Atlanta to Nashville from a time perspective works. Boston to LA does not work, right? So you have underutilization of donor organs just from a geographic perspective. But the other piece is, kind of marginal or what they call extended criteria organs, are also not being utilized. And that's because you don't know how the transplant recipient is going to respond to one of these marginal organs. Whereas now when you put it onto a TransMedics machine, you can see how it responds, right, to, being basically inside a body. You can do diagnostic work on it. You can even do therapeutic work on it. And so basically that's another aspect in addition to geographical reach, right? You're using more of these organs that were being discarded. So, the benefit is kind of twofold, right? Better post-transplant outcomes and better utilization of donor organs. So that's kind of the idea behind TransMedics. And this is just a quick chart showing, look, like of the, call it, 13,000 donor hearts that are out there every year, only 30% of those are being used. And same thing in liver, it's a little bit better at 60%, but that's still pretty low when you think about how long these transplant wait lists are, right? Like we need to be using more organs, and the TransMedics system enables that.
I mean, it sounds like incredible. I've always wondered the same thing as a kid. I used to watch like on TLC, they'd show like heart transplants on television, and like how does that work in a box full of ice, And
yeah.
Same thing, like how long is that going to last? So with the TransMedics machine, how long could you in theory keep a heart fresh or viable?
Yeah. So look, it's longer than 4 hours, right? And they use an example of a lung that they kept on the machine for 25 hours, which is, kind of mind boggling. But the point is, it's significantly longer than 4 hours. And it's going to depend on, which organ is being donated and lots of other variables. But
yeah,
the point is basically now geographically, you can match with anybody in the United States, where previously you could only match, right, with someone in a city very close to you. So kind of more regionally. And I think the other interesting thing here, right, technology makes a lot of sense here. But the piece that I think is kind of building a moat around the TransMedics company is they have what's called their national OCS program. So think about this as basically a white glove service where they will deliver donor organs to transplant hospitals. So what they've done is they have 16 cities across the country where they have thoracic and abdominal surgeons on staff. So let's go back to that Boston to LA example. Let's say you match with someone in LA. And previously, you could have never used that organ without the TransMedics system. Now you actually will call up TransMedics and say, hey, can you actually procure this organ for me and deliver it to me in Boston? And they do that, right? They do that with their surgeons, and then they put perfusionists on the plane, fly it to Boston, the organ's in great shape, and you're ready to go. And I think that has enabled very broad adoption of this technology in the last year. Because if you think about it from a hospital perspective, before there was this kind of logistics network out there, the hospital actually had to buy the OCS device. So that's a CapEx outlay. They didn't know how much they were going to utilize it. They had to train their staff on it. So there were lots of kind of barriers to adoption. Now, TransMedics says, hey, look, we handle all that for you. You don't have to train. You don't have to spend CapEx. And oh, by the way, you basically just doubled the capacity of your transplant team because they're not flying out to procure organs. They're just sitting at home, waiting until the organ gets there. So huge efficiency gains for these hospitals. And you're seeing it in the data. So last year, TransMedics revenue grew 200%. So I think there's pretty broad interest in this technology today.
Does anyone do this? Anyone else do this?
It's a good question. There are some competitors in the normothermic, which means, keeping the organs at kind of the temperature of the body. There's a company called Ex Vivo, but they are only approved in lungs. There's Organox out of the UK. So they have a device for the liver. Neither one has a lot of funding. And so I think that's going to make it really hard for them to compete with Transmedics. And then I think there's a couple of other, potential competitors, whether it's from hypothermic perfusion. So that's where you just pump cold oxygenated solution through the organs. Or there's something called, and this is getting a little bit morbid, but unfortunately, there's something called normothermic regional perfusion. So you would actually, after somebody passes away, you would basically clamp off blood vessels. So no oxygen blood is flowing to the brain, and then you would just restart the heart in the body, and it perfuses the organs. There's all kinds of ethical concerns around that, but I think it's a technology that bears watching.
But within the U.S., is TMDX the biggest player in the space, and just from a market share standpoint?
Yeah, call it 95, 98% market share, right? I mean, they're it.
Yeah. And what's the sort of basic corporate history here? Like, when did they go public? Is the founder still the CEO? Who's running the business?
Yep. Founder is the CEO. I can't remember. I think they went public in 2016. I can't remember the exact date, but the first FDA approval of their device was for lungs in 2018. If you kind of think back there, there wasn't broad adoption in the lungs. I think that's twofold. One, they didn't have this NOP system set up to kind of deliver the organs. But two, right, if you think about it, it's approved in 2018, they start to commercialize it in 2019, and then COVID hits. COVID obviously acutely hits the lungs. Transplant volumes were down. Transplant centers just really weren't interested in new technology around lungs. So they've really only seen growth in hearts and livers. And that's where all their growth is coming from today. And frankly, as I underwrite this business, that's all I'm underwriting. They just have not had much success with lung.
What's the market cap?
I think today market cap's around $2.5 billion.
Got it. And just walk me through kind of like the basic valuation case here. It seems like there's a pretty sizable addressable market, but I'm just curious what your own growth assumptions are, long term, given that you like to own things for extended periods of time.
Yeah.
What you're going to look like, and what the sort of unit economics are as well of the business.
Perfect. Yeah. So, I think you have to have a long-term perspective on this, right? I mean, the heart and liver were approved in 2021. So these are still, pretty new products on the market. And so the way they make money, right, is that consumable that goes in the device. They charge for that for every transplant. It's reimbursed by insurance. And we've kind of got some early data points on kind of what industry adoption rates could look like here. So, and if you look at the research that I have published on SumZero, you can kind of see comments from early adopters of the technology. They think it expands the market, by at least 30% in terms of being able to utilize some of these marginal organs and the geographic reach. And some of these early adopters saw Transmedics being used for 30% of their procedures last year, which is amazing in the first year post FDA approval. So as I think about it, right, I think that the market overall is going to grow through 2027. And I think Transmedics ends up, probably getting a 30% penetration rate in both hearts and livers. I'm not forecasting anything for lungs. And then, those revenues carry an 85% gross margin. So very high gross margin product. They'll have some services that go with it, right? This NOP program, that's lower margin. But if you kind of think about this company at maturity, right, call it 2027, they have 30% market share. That's call it 6,500 organs per year. And then they're probably at close to kind of high 20s EBITDA margin, approaching 30%. And that's kind of in line with what management has outlined. So their target by 2027 aspirationally is 10,000 organs. I'm not as optimistic.
What do they charge per organ transplant?
Yeah, great. It's $65,000, per transplant. And so it is reimbursed by insurance. It's a big cost, but if you think about it from whether you're the hospital or the insurance company here, the cost to keep a patient who is waiting for a heart or liver transplant, to keep them, or to treat them while they're waiting is very high. right? So everybody involved here is incentivized to use the device because it just, again, it improves post-transplant outcomes, and it's going to be lower cost for the hospital and the insurance companies. So even though it's a high cost, it's cheaper than the alternative.
Yeah. So doing the math on that, they're sort of targeting $650 million of revenue roughly on just the cost of the sale of the transplant of the I
Yeah.
guess it's one organ, one machine per, or is it 10?
So,
Is it 65,000 per transplant?
right.
And then
Per transplant. And then the cost of the service, right? The NOP service is, call it $20,000. And then, a piece I haven't mentioned, right? They're actually going to vertically integrate this logistics piece. And what do I mean by that? I told you that these surgeons have to fly, right, to procure the organ and then fly, right, to deliver it. Well, they actually broker planes right now, which has a lot of added costs for the transplant center. So you're paying a brokerage fee, you're paying the owner of the private jet to use their jet. So it increases the cost a lot. So Transmedics raised some capital through some convertible notes earlier this year, and they have earmarked that capital to either buy planes or lease planes because they think they've effectively run out of capacity in the brokered jet market. So they think the growth is there, and they actually felt like they needed to vertically integrate. So they will charge for that as well. So there's kind of three pieces that they charge for. Obviously, the consumable is the high margin. The rest of this is low margin, but I think it just enables the high margin revenues.
yeah, so they don't. It sounds like they don't sell the machine itself. It's more they sell the services around each use.
Right,
And
and that's a change in the business model, right? Originally, they were going to sell the machine. They were selling the machine to Duke. They were selling it to Vanderbilt. But if you weren't a high volume hospital, it never made sense to buy the machine. And I think that's when they realized this logistics network was key to enabling the adoption of the technology. So I think it's something I was kind of unclear on, but as I got to know the company better, I really buy into that because I see why it makes sense for everybody involved.
yeah. Now, why is this cheap, in your opinion?
So certainly not cheap on any near-term numbers, right? But I think that, again, when I go back to like the investment philosophy behind Headwaters, right? And this idea that there is time alpha to be earned in the market, right? The market's only going to pay up for revenue over the next year or two by so much, right? And so it's really hard if you have a company like this, right, that's going to compound, and I don't have the numbers in front of me, but if they're going to grow 30, 40% annualized or at a 30, 40% CAGR over the next 5 years, it's very hard for the market to price that in the short term, especially when they're on the cusp of profitability. And so it is not cheap in the short term, but I do think if you have the ability to look out to, call it 2027, and again, I kind of gave you the framework for revenue, call it high 20s EBITDA margin. It's a business, right, in the med tech space that is very unique. I think it will command, an EBITDA multiple around 30. So you get to a $150 price target in 2027. And, from today's price, that's, call it a 15% annualized return. And so, that kind of meets my hurdle rate. But again, if you're trying to get that in the next year, it might be tough, but if you can be patient, I think that's where the opportunity is here.
Yeah. Do you hedge any of your positions, or are you pretty much long only?
Long only, no hedging. I mean, there's a lot of due diligence that goes in on these companies. So I've been to Boston to meet with the management team here. And so it's a very high conviction approach. So really no interest in hedging, given the conviction around every name that's owned in the portfolio.
Yeah. And how did it hit your screen in the first place?
Yeah, a great question. So it showed up on a revenue growth screen that I run. And honestly, though, it was more just reading research around it. So I've kind of followed it really since 19. But they never had success with their first product in lungs. And so I just watched it because like the technology made so much sense to me. And I would never buy a company, right, where they don't have FDA approval for a product. And it honestly, it reminded me a lot of another company in the med tech space that I've owned and has been a very successful investment. It reminds me a lot of that one. And so Just kind of watched it. And I think last year was really like the inflection point where, they've got FDA approval, they've got this NOP network set up, and you can see early proof points from, the high volume transplant centers that I think are kind of the breadcrumbs for telling you how this ends up being used by the whole market over the next few years.
Yeah. So let's transition to something that is at least optically more of a value play. Can you give us a name in your portfolio that isn't sort of high growth, high multiple, but something that maybe feels a little bit more GARPy or more value oriented?
Yeah. Good question. Cause I kind of led with, I think small caps are cheap. They've been cast off, right? They're not, they're ignored by the market. I don't think that's true on Transmedics. I still think it's a good opportunity, but probably a better example of kind of, my broader thesis on small caps is a company called Insight Enterprises. Ticker is NSIT. So Insight is a solutions integrator. That's kind of a nebulous term, right? That doesn't mean a lot to me. I kind of think of them as an end-to-end enabler of digital transformation for Fortune 500 companies. Again, probably, that doesn't make a whole lot of sense to people as well, but their roots are, they used to be a value-added reseller, right? So what they would do is for their Fortune 500 customers, they would go out and procure, right, all the laptops that you would need for all your employees across the globe. And they procure it. They would then load on software, they customize it, cybersecurity, whatever you would need, right? So that your employee can hit the ground running. And then they distribute that all over the globe. So that's kind of their legacy. It's a very low margin business. Okay, returns on capital, but very cyclical, right? If you think about just the hardware nature of that business. And what they're kind of transforming into is, again, this end-to-end enabler of digital transformation. So now they provide consulting services up front. They still do all this hardware management. They can now procure software for you. They do an implementation of any project, and then they can manage that project on the back end. So think about like if you're trying to go from on-prem to the cloud, right? Insight's a great partner for you to kind of design that project, to procure everything you need, implement it, and then manage it on the back end. So they kind of have 6 focus areas. So their focus areas are modern workplace, modern apps, modern infrastructure, intelligent edge, data and AI, cybersecurity. The point of that is, right, they're in kind of the growth areas of the IT landscape. So that should enable them to grow a little bit faster than the market. So that's what Insight does. Again, I kind of told you the IT landscape is pretty broad, right? And there's a lot of players here. So one of their competitors called Converge Technologies listed in Canada, they actually have a great slide that I think kind of gives you a backdrop of what this market looks like. And I think it's really important to understanding Insight. So if you're kind of at the low end of the market, there's the pure distributors, right? So that's the TD SYNNEX, the Ingrams, right? Very low gross margin business, right? They're connecting the OEMs with the end customer. They're a pure distributor, right? As you kind of move up market, you get to the value-added reseller. That's the example I gave with Insight, right? They procure the hardware, they customize it, send it out to you so you can earn a little bit more margin there than a pure distributor. Then there's what's kind of the solutions integrator, right? Again, you're tying more services and software around it, so a little bit more margin. And then on the highest end, you have what's called the systems integrators. These are kind of like the pure consultants, think Accenture, Capgemini, right? They earn the highest gross margins, right? They're doing big like ERP implementations, long projects, throwing a lot of bodies at the project. And so that's kind of the marketplace, right? And so then if you kind of step back, you say, well, like, there's a lot of gray areas here, like who's a competitor, who's a friend, right? So I think it's interesting because like Insight's got a very unique position here. So they've got their history on the VAR side. And if you think about it, if you're Accenture, right, you got this high margin consulting business, like you're never gonna, try to vertically integrate and then, have to take on the working capital requirements with being a VAR, setting up a global distribution network. Like they're never coming down into Insight's world, right? And then if you go like to the far other end, back to the Tech Datas, the TD SYNNEX, the Ingrams, they're so big, they're focused on, consolidating the market, taking out costs. Like them adding services just doesn't move the needle for them. And so then you get to Insight, and it's like, okay, their legacy in the hardware side uniquely positions them against some of their competitors. So like if you're a smaller competitor, you can't serve the Fortune 500 companies with a global distribution network like Insight has, or the reach of OEM relationships that Insight has. And so they've got a really unique spot in the market, and they're small enough where if they start to add services and they can, perform more of these cloud deployments, right, it can really move the needle for them. And so that's really the opportunity here, right, is they start to add more of these services and these higher margin revenues. I think when you look forward in a few years, again, it's going to be a company that's got higher margins, lower capital intensity. And so the returns on capital are going to be much higher than they are today. And that's kind of the investment opportunity here.
Do you look at them on like an earnings, like a PE ratio basis, or what's kind of the metric that you care about?
Yeah, I mean, I typically use an EV to EBITDA multiple just for most of the names I look at. I mean, you could look at this one on a PE ratio. It would give you the same conclusion. They're trading within the range they have historically traded. So historically, they've traded between 8 to 10 times EBITDA. And I think that's because, right, it was a low return on capital business. It was cyclical given the device exposure here. But I think, right, as they transition in the future, all those metrics are going to improve. So, at a minimum, they should trade at the high end of their historical range. And I don't think it's unreasonable to think that they trade, kind of 10 to 12 times EBITDA. CDW would be their closest competitor here. CDW plays in the SMB space, so they don't really compete with Insight in the Fortune 500 space. CDW has traded 13 to 18 times EBITDA historically. I don't think Insight will get that multiple just because CDW, by targeting the SMB space, can actually get higher margins, better working capital terms. So their returns on capital, I think, will always be higher than Insight. But again, like, could Insight have, trade at 12 times EBITDA in a few years? I think so. And so the backdrop, right? And I'll flip
it
forward.
did. What would the return be for investors today?
Yeah, so at their investor day last October, they laid out, projections to 2027. And so what they're saying is, hey, we are going to try to grow our gross profit by low double digits, at a low double digit CAGR over the next 5 years. Right. And again, that's led by the shift to higher margin services and cloud gross profit. And they'll leverage SG&A there. So you're going to get EBITDA growth of, call it, 15% annualized through 2027. So if it holds the low end of the multiple, the high end of their historical multiple, the low end of what I think it'll trade at in the future, you're getting a 15% annualized return. And if you think it can trade up to 12 times, you're getting a 20% annualized return. And I'll just note, all of this is organic, right? And this is a business that throws off a lot of free cash flow, and they've historically been acquisitive. And so I think they will probably supplement all this organic growth with M&A. And I think that just accelerates this portfolio transition, right? They're going to do M&A in kind of these growth areas. So I think you've got a good baseline, and then you've got upside from M&A.
What's the free cash flow yield right now?
Ooh, that's a tough one, right? This one's really cyclical. So think about 2020, 2021, they were having to purchase all these devices for their customers. So it's a huge working capital build. And they're actually throwing off a lot of cash right now as, the device growth has turned negative. So it's really hard to look at, at a point in time, but they kind of say through a cycle, they think they're getting 90% free cash flow conversion.
Interesting. How do you think about risks to your thesis here? I mean, it sounds like a pretty crowded space. Is competition the biggest one, or are there others?
I think, there's a couple things, right? I think there's just the cyclicality of the business. And I think that's, everyone that's probably looked at Insight over the last 5 years thinks of it as having this device legacy and it being pretty cyclical, right? Again, I think over time that becomes less important to this story. Competition, I think, would be, a big risk here. But again, I just think Insight's scale and the customers they're serving serves as a pretty big moat compared to smaller competitors. And frankly, again, given how acquisitive or all the M&A that's happened in this landscape, right? If they saw somebody, that they thought was competitive, I think they're at a size they could probably acquire them and just tie that new service, right, or new product into their portfolio. And that's why M&A is so attractive in this business is there's always a hole to fill, whether it's geographic or product or customer set. And so strategically, M&A makes a lot of sense. And it also makes sense financially, as a lot of times there's costs that can be taken out or there's revenue synergies.
Well, is there anything about the thesis that you think in the markets are not pricing in or just don't fully appreciate? Is it this service kind of margin expansion that you're saying is going to come from like a mix shift in terms of them doing more consulting like work or something else that maybe investors just don't realize yet about the business?
Yeah. Well, certainly the cycle, right? So they've seen device growth has been negative for 3 consecutive quarters and is likely to persist through the end of the year. So I think there's a lot of concern right now on just headline numbers coming down, and it may be persisting longer than everyone thinks. So I think that's one thing that I think investors are concerned about that I'm not as concerned about because it's the low margin piece of the business. And then, yeah, right. These are pretty aggressive 2027 targets, right? Core services and cloud gross profit growth of kind of upper teens. That's not a layup, right? And so I think investors are in a little bit of a wait and see mode in terms of, can they make some progress here? And again, in discussions with management, I think there's a lot of levers they can pull, and they've kind of set the company up well to hit these targets going forward.
How's the balance sheet?
Yeah, balance sheet's clean. So currently less than 1 turn of leverage. Again, like I said a minute ago, they're throwing off a lot of free cash flow right now. And so, they'll be kind of close to a net cash position at the end of the year if they don't, do any M&A and, depending on, how aggressive they are with share repurchases.
Got it. Well, I think that's a good place to wrap up. Maybe just lastly, where can folks learn more about Headwaters?
Yeah. Well, first of all, both of these companies, both TransMedics and Insight, have posted, more detailed write-ups on SumZero. So anyone that's interested, definitely go check that out. I've got a website, headwaterscapmgmt.com. You can sign up for quarterly letters. You can get in touch with me through the website. And for anyone that's interested in these companies or just has similar investment philosophies, I'm always open to talking. So yeah, thanks for having me on. This has been great.
Yeah, it's been fun. And I think it's interesting that you've got kind of 2 very different names in the portfolio. One maybe requiring a little bit of a VC hat, the other one a little bit more mature. But I think, it's a sign of sort of a flexible sort of investing framework, which is always good. But Chris, thanks for joining us. And, we hope to follow up. And, I'll be certainly tracking these names myself. That organ, TransMedics in particular, at least for me personally, it's such a visceral product. I feel like it seems like one of these no-brainers that, you never hear about that business or businesses like that business, but you can very viscerally feel the need for it. And I think the product itself sort of expands the market in a way that is quite compelling. So anyway, I just thought that one was extra interesting.
Yeah, I couldn't agree more. That's definitely the more exciting one. Hopefully people stuck around to listen to Insight, which is a little bit more of a grinder, but I think still has equal amount of upside from a stock perspective.
Awesome. Thanks, Chris. We'll be in touch.
Thanks, guys.
Take care.